Good afternoon and welcome to the D4T4 Solutions PLC Post-AGM Q&A session. Throughout this session, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Peter Simmons, Chairman. Good afternoon to you, sir.
Thank you very much, Alex, and thank you everybody for joining this Q&A session this afternoon. As I think probably everybody's aware, we did the formal AGM at 9 a.m. this morning, and I'm pleased to announce that all the resolutions were passed with over 99% majority. So that's already been put out by RNS, I believe. I think most people will also be aware we put a brief update out this morning via RNS. So for the benefit of anybody who didn't read that, I'll just read that out now. It read as follows. AGM trading update and contract win. D4T4 Solutions, the AIM-listed data solutions provider, is pleased to announce a contract win with an existing banking customer. The contract was one of the two contracts previously mentioned, which were expected to have closed in the last financial year. This contract includes a high proportion of low-margin hardware and is expected to be substantially delivered in the first half of the current financial year. This contract win accounts for a large proportion of the revenue shortfall from the last financial year. At the AGM this morning, the chairman confirmed that the group has a strong pipeline and is very confident in the group's strategy to deliver growth and create significant shareholder value in the coming years. So that was the AGM statement this morning. So before we move on to the Q&A, I thought one of the things that would be appropriate to cover in this session was board changes. There are two, effectively, that we just, I guess, need to bring everybody up to date on. The first one is the appointment of Helen Gilder, who you can see on the call there. Helen, wave maybe. Helen joined us a few months ago and has joined as Audit Committee Chair and Non-Exec Director. And for those of you that aren't aware, in my role as an NED and Chair, I was also Chair of the Audit Committee. So as part of the succession planning for finding a new chair replacement, and for those that don't know, I'm coming up to 9 years early next year, and therefore under the corporate governance rules have to retire. So as part of that succession planning process, we sought via professional headhunting process a new non-exec who could take on the Audit Committee Chair role, and I'm delighted to welcome Helen, who brings a lot of relevant experience both in business as well as an NED, and Helen has now already in fact taken over the Audit Committee Chair from me. So welcome, Helen. And yes, just to confirm, we're also in the process at the moment as part of the sort of orderly succession of running a process to find a new experienced chair to take over my role, which will, I guess the process is reasonably well advanced already. We're down to a long list, I think the headhunters like to call it, and we'll be starting the interview processes once the world's back from holiday, probably early September, and watch this space for further announcements, I guess. But anyway, that's the board changes. So moving on to Q&A. Obviously, if anybody who's on the call has got questions that they'd like to submit, please feel free to do so using the platform. What we tend to do is if we get duplicate questions, we'll aggregate them rather than reading them all out individually. And we've had a number of pre-submitted questions, so I'm going to kick off with some of those. So the first one, I think possibly is already covered by this morning's RNS, but the first question was, and I guess it was the one that was sort of top priority for a lot of people, was what happened to those deals that slipped at the end of last year? So Bill, can I hand over to you and you can give everybody an update on that?
Yeah, sure, Peter. So as you read out in the RNS, the one that was the sort of lion's share of the revenue that we announced on the 3rd of April, RNS has now closed, with the majority of that the hardware revenue on that sort of falling in this first half, as you outlined. The second deals with an entertainment company for a Celebris license. Conversations are still very active, but candidly, it's on their side because they've had quite a few changes on their side, and they've had some business stuff that they're sorting through is probably about all I can say. But we've agreed legals and we've agreed a contract, and we're just waiting for them to have the appropriate staffing to proceed.
Excellent, Bill. Thank you for that. And I guess the next question here kind of follows on from that, really, which is a question about pipeline. And are you seeing improvements in both the pipeline and the overall sales cycle? So, Bill, I guess that's another one for you.
Yeah, I'm quite happy with where the pipeline is growing and the conversations that we're having. From a direct standpoint, we've alluded in the roadshow, which was only about a month ago. But for those of you that weren't in some of those meetings, about 65-70% of our pipeline is now direct sales opportunities, which is putting us in the driver's seat and giving us better control over how we move those deals to closure. So we are seeing a shortened sales cycle. We've also learned a lot throughout that process. And I also see that we've got some questions or a question around some of the Salesforce deal flow as well. So I might as well just tack that on to this one, Peter, because it all kind of comes together. With Salesforce, those of you that have been following Salesforce, you might actually have seen that they were in the news for some unfortunate reasons on their part the other day with regards to a lawsuit around the lack of real-time ability of their CDP, which is something we run into around the globe with everyone's CDPs, and a key differentiator for our platform in making those better. With Salesforce, there's several clients already using the integration, which is good news now. We have actually 2 sales meetings this week with existing customers to add the Salesforce CDI integration to their platform. And we have 4 or 5 deals that we're working actively with Salesforce, with a new one that entered the pipeline yesterday. So pretty thrilled across the board with how the pipeline's building. With Salesforce, we've had some conversations with their data cloud team as well. And I suspect, given some of the news that has hit the wire, that might get escalated a bit faster, because we can add a lot of value there to solve for some of their lack of real time that they allegedly have, according to the paperwork that was filed this week.
Great. Thank you, Bill. So you mentioned there in your sort of response to the first question about direct sales. Give us a bit more color on how it's working out to have a direct sales channel.
Yeah, so it's interesting. We're sort of in the process of building a machine, for lack of a better word. It puts a different focus on how we market and the types of things that we market, and you'll see some of that actually coming in the next few weeks with some additional product launch and features that we're bringing to the market. But then that carries through into how we're developing business. So we have sort of people doing the old school, pick up the phone and calling, business development reps out finding leads, basically working for the sales staff. We have the sales staff holistically focused and incentivized on selling licenses. And then we have the customer success team that we've stood up, who now is solely focused on hitting a year-over-year target of growth in their respective markets for existing customers. And all of that is designed to, in essence, continue to advance our land and expand model, where the sales team is focused on identifying the pain point and as quickly as we can, selling them a portion of Celebris to solve that pain, with then customer success coming in to pick that up and expand that customer and get them to start using all the other features and functionality that we offer them across the platform.
Okay, great. I just noticed another question popped up, which is a supplementary question about the RNS. And it says, can you expand on this morning's comment about a high proportion of low margin hardware? Bill, are you happy to take that, or do you want Ash to cover that one?
Well, I can talk about the deal structure, and then I think it would be helpful for Ash to give an overview of just the margins that we've put in place, because we've also changed our hardware margins a bit as well. But the deal structure, so this is an on-premise analytic environment that we manage for one of our banking customers. Our focus going forward has been cloud first, as the Celebris platform is fully cloud enabled across AWS, Azure, and Google. And so that's our desired approach. It brings benefits to us, it brings benefits to the customers, and frankly, it allows us to get our features out to customers much more quickly than an on-premise environment, where we're working through internal client IT teams and security teams. That particular deal is a mix of hardware as well as software. And the margins in all of those categories, whether it's hardware, software, services, et cetera, all vary. And I'll throw that over to Ash to sort of talk through sort of how we view those margins, if you don't mind, sir.
Yeah, thanks, Bill. So let me just explain sort of our revenue stream and the margins within each of the revenue streams. So we've got 4 different revenue streams effectively that we disclose in our results. The most important one of those is our license revenues, and that's most important because it's the highest margin. So typically in the industry, software industry, you'd see a license revenue having a margin of somewhere around 85 to 90%. The one below that in terms of profitability is our support and maintenance, and that includes now also our Celerus Cloud offering as well. And typically with the support and maintenance in the software industry, you'll be looking at somewhere between 70 and 75%. And then below that, you've got services, and those might be services which are kind of additional to actually implementing the product or doing upgrades or all of those things for a customer. It also includes some element of long-standing customers that we have for whom we provide services, perhaps around data installations or web services and things like that. So web services, services in general, probably around 40%. And as Bill said, we have this element of hardware, which is very lumpy year to year. And that typically, historically, has had a margin of 10%, and we've recently increased that up to 15%. So those are the different margins. Now, in terms of understanding what the blended is, historically it's been quite difficult to understand the margin because of the degree of lumpiness of hardware year to year, which either sort of depresses or flatters the margin. So this year, for the first time, we've split out the hardware. So what we're disclosing as a key metric is software revenues. And that also provides a better underlying trend of where the revenues are going without the lumpiness of the hardware revenues. But in addition to that, we've also shown the software revenue gross profit percentage. We think that's a better metric in terms of understanding where the business is going, and certainly better to understand how the margin might increase in future. And so on that point, so in future years, as we sell more new logos, as we have more sort of upsell with existing customers, typically in those scenarios, you'll have a breakdown of 80% of license and 20% of support and maintenance or services. And so what you'll see then is that as we get more new customers on, the proportion of revenue, which is license revenue, will increase. And so we expect the overall software gross profit percentage to increase over time as well.
Okay, thanks, Ash. Another one that's just popped in, Ash, which kind of definitely one for you. It says, for a typical contract, when you sign a contract for 5 years, how do you recognise the revenue year by year?
Sure. Well, let's take the most typical scenario. So it's a 3-year contract, either a new logo or a renewal. And within that, we'll have the license, we'll have the support and maintenance or the Celerus Cloud, and we'll have an element of services. So with the license, what we do is we recognise the annual license in one lump sum. So at the point of sale, and then 1 year later for year 2, and then 2 years later for year 3. And that's a requirement under IFRS, because once we've delivered the license, our obligations essentially are fulfilled. And so we have to recognise the whole of it in that month. As for the support and maintenance and the Celerus Cloud, well, that's a service which is offered month by month, of course. And so we recognise those revenues each month proportionately. And then as for the third item, the services, well, that's typically either a T&M, so time and maintenance, and we'll be recognising that as we deliver the services. And in some cases, it might be on a percentage complete basis. So if it's a 3-month project, for example, we'll estimate the percentage complete month by month, and we'll recognise the revenue on that sort of time recorded basis.
Okay, thanks, Ash. Bill, there's one just popped in, which is probably aimed at you, I think, which is when you're building up a direct sales team, what are the limitations to scaling, and how is it helping give you better visibility of future new wins?
Yeah, no, it's a good question. And also just harkening back to the revenue one, hardware, by the way, we recognize on delivery of hardware to the client's data center as kind of the final point. So that's why it's so lumpy as well, because it can be a pretty large number of or amount of hardware that we deliver. From a sales team perspective, I think the key point that I'll highlight is, in our financial year results from this previous period compared to the last, the OpEx stayed flat. We did that while standing up a direct sales business, while standing up customer success, et cetera. So we've managed the costs within the business quite well through our restructuring to make way for this, which was part of the plan that Ash and I and the management team had put in place. From a visibility perspective, having direct deals gives us much more control. In a reseller channel, we're sitting in many cases behind the partner. We don't even always have direct access to the customer, and we don't necessarily know all the levers that can be pulled to get a deal done. So when it comes to sort of building out the direct sales pipeline, I like to think of it just like all of you, with diversifying your investment portfolio. For me, it's all about how do we diversify all of our revenue streams so that we're not holistically dependent on a single one. And so that in a given quarter or a given year, we can be looking at all the deals like we do now at the start of a quarter, and we look and see which ones can we get over the line potentially this quarter, and that's where our focus goes. So it does give us quite a bit more flexibility. There really haven't been any limitations. We've stood up the team that we intended to stand up. We added customer success like we intended to. And we made way for those costs by making efficiencies elsewhere in the business as a result of the different platforms we've put in place or some of the restructuring that we've done across the business.
Great. Thank you, Bill. Ash, this is probably one for you, but you've talked, I think, in some of the previous communications about improving internal processes and creating efficiencies, which leads on from what Bill was just talking about. Do you want to just give a quick flavour of some of the things that have helped with making the business more scalable?
Yeah, sure. So this time last year, we talked about the systems we'd implemented at that time, which included a new CRM. We're using HubSpot. We had implemented a contract manager, a license manager, and we'd also implemented an HR system called HiBob. In the last 12 months, we've also then, on top of that, implemented a new finance system, which is Oracle NetSuite. And these are important for a couple of reasons, as you say, Peter. Partly, they're important because they produce efficiencies in terms of how we operate. They allow us to share information better across departments. But the other point, as you say, also is that they allow us to be scalable. So as we systematize how we operate, it's much easier to add new headcount and integrate them into the processes that we're operating, because a lot of those processes are then driven by the systems. So that's been an ongoing project, and that's largely complete now. We are looking at other systems which are probably in the short term less critical that we might implement in future. So, for example, perhaps a project management system to replace the one we currently have. And of course, once you have these systems talking to each other, they provide a degree of granularity in terms of what's happening within the business. And that's also a reason why we've been able to sort of vary our pricing more accurately to produce the margins that we need to be producing. And also in some cases, we've had to walk away from customers who are non-core and not profitable.
Okay, actually, there was a specific question on that, Ash, and maybe you just want to talk a little. I'm assuming these are, in the main, legacy customers whose volumes and spend with us have declined over time that you've kind of looked at.
Yeah, it's exactly that. So it's customers who are long-standing customers, non-core, so non-Celebris, which is what we're trying to drive here. It's software revenues and licenses. And so, of course, these customers, as they're reducing in number, still require us to maintain certain skill sets, and that becomes inefficient and unsustainable when you have a diminishing number of those sorts of customers. So we've accelerated that sort of transition effectively, and so now increasingly the bulk of our revenues are Celebris or software driven. Excellent.
Okay, Bill, this one's probably for you, but there's a question about expansion or continuing the growth in Far East and Australia.
Sure. So from a focus perspective, the majority of our focus at the moment is growing the US business, because that's where we think the majority of our opportunity lies. In APAC, we have some existing customers, such as an airline, a pretty large airline that we've expanded with in this previous year. And we're working through partners in that region because we found that the easiest way to service it at this point in time in terms of scale. So we have some good partners that we've been engaged with, a couple of new services partners as well that we've brought on board. And we have a handful of opportunities that are floating around in that region via those partners, and some historic partners that we worked with that we're revamping the partner agreements with as we speak to drive ideally more logos through them as well. So I think for the Far East, that's how we'll continue to support that in the short term, because it helps us with scale, and it lessens how much we have to invest to drive some success in that market and region.
Okay, great. Question here, Ash, I think probably aimed squarely at you, but Bill, feel free to chip in as well, which is a question about the 17 million of cash on the balance sheet. And, it's obviously reassuring. It means that the going concern question and discussion with the auditors is a relatively short one, but I guess people are asking, well, what are you going to do with it?
Okay, well, I'll pick up the first part of that, and then maybe Bill, if you want to follow through on the rest of it. So essentially, off that balance, we regard working capital requirements to be somewhere in the region of 10 million. Now, by the nature of the business, we have a lot of lumpiness also in our cash flows. And the reason for that is that when we sign a new contract or when we have a renewal, the customer will typically pay the whole of the first year's license and support and maintenance in one lump sum. And in months where we don't have that, I mean, in general terms, we might be billing perhaps 500,000, but there'll be other months where we have a number of those and we might be billing 4 or 5 million in a month. So there is a degree of lumpiness to our cash balances and our working capital requirements. But we regard 10 million as being a sort of a sensible level of working capital cash. The surplus beyond that is there to provide any sort of cushion we might need in terms of a buffer. It also requires us to have the capacity to invest when we choose to do so. And of course, there's always a sort of like a lag sometimes between the investment you make and the return on investment that you get from that investment. And then the third part of it, of course, really relating around sort of broadening out the business through M&A, which perhaps, Bill, you want to talk about.
Yeah, I can just follow on from that. I mean, there's nothing imminent. I always like to lead with that, but we have been much more active in the M&A space, working with advisors, looking for potential a technology company that would be worth acquiring to bolt on to the Celebris platform. We have a profile of what it is we're looking for. We've actually, in the previous financial year, we did explore a couple of companies that didn't pass the sniff tests from our engineering teams. But we'll continue down that path, and ideally we find something that's a good fit and come up with a strong acquisition for the business that's a 1 + 1 = 4 scenario.
Great stuff. Okay, right, we've got a new one just popped up on the screen, Ash, which is definitely, I think, over to you, which is how's the office search going?
That's an interesting question. Well, the office search is going very well. So we have identified a new office space. That space is around 6,500 square foot compared to the 17,000 square foot we currently have. And of course, post-COVID, the hybrid working scenario that we're in has enabled us to do this. So the situation with the new office is that we're going through lease negotiation and through the fit out plan that should be completed in the next month or so. And then we would anticipate moving into a new office probably somewhere around November, December time. And then I assume this is also alluded to is what are we going to do with our current office? Well, it's currently up for sale. So it's on the market. We've had interest from quite an interesting range of potential buyers, ranging from budget supermarket chains, investors looking to turn it into a residential property, which in fact there is close by in Sunbury, not too far from the industrial area that we're in. And then we've also had interest from people who want to turn it into a school and a nursery, which actually would be an interesting use of the building. I think it would lend itself quite well to that. So most of those discussions are at an early stage at the moment.
Okay, great. Well, I think that's probably covered all the questions that have come in. So unless anybody's got any last questions that they want to fire up on the Investor Meet Company platform, I think we're probably close to wrapping up.
Perfect, Peter. Thank you very much for that. And I think you've actually addressed all those questions from investors. And of course, the company will review all those questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors, provide you with their feedback, which I know is particularly important to the company. Bill, could I just ask you for a few closing comments?
Yeah, just thank you everybody for the time and the questions today. Hopefully the answers help give you a glimpse into where the business has come from and where we're taking it. But as always, if you have any questions or you'd like to get communication to Ash and I, you can reach out directly at investors@d4t4solutions.com or via FinCap or Canaccord.
Perfect. And thank you once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of D4T4 Solutions, we'd like to thank you for attending today's session, and good afternoon to you all.
Thanks all.